Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and what has become my growing amount of social media platforms. Uh, I am continuing to talk and teach about closed-end funds and how we're using that investment strategy inside the stock market. So if you want the full methodology and all the 12 steps to financial freedom, then head to Facebook and check out my page, Adapted Perspective, Navigate Your Finances, where I give you the entire framework for free. Um, I've started an additional Adapted Perspective platform on Facebook targeting scholarships and helping kids, students really of all ages, but helping kids uh, find scholarships um, all in one location. There are several paid for services regarding scholarships, like in order to access our list, pay a membership fee. And that just seems, I mean, I get why people do it, but that just seems disingenuous to me. So I've started a scholarship hub and am allowing it open sourced where you can enter scholarships, I can enter scholarships, and everybody can see the scholarships for nothing, so completely free. Uh, so that also has an adapted perspective handle. So if you type in adapted perspective on Facebook, you should see navigate your finances, and you should see another one for scholarships. So this is an unedited video. I mean, yeah, so who knows what you'll hear in the background, which it might be coughing because people are fighting allergies. It could be cats because I've got some hungry, rather vocal and outspoken cats when they get hungry. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So our self-managed closed-end fund or CEF portfolio is built on lasting dividends, not the gradual sell-off of own funds. And that means the day-to-day, week-to-week pricing doesn't weigh on me, which is very different from most market advisors and most investors. And our strategy, I mean, the strategy plays into that. I mean, we're in it for the long haul. So we play the long game. That's using current market data, strategizing and looking forward of where the market will go, and then playing that game, not the I'm going to buy it today and sell it 4 days from now. If you watched, which I don't watch a ton of TV, but what little I watch about the investing circle junkies, they all say the same thing, and they all give crappy advice. Uh, a lot of that advice structure is dead, like a 60-40 stock to bond portfolio, 4% rule. Um, so if that's bad advice, if that's dead advice, then we should adapt our strategy. So we created a no withdrawal portfolio. And I'll be the first to tell you we didn't invent or reinvent the wheel. It's uh, when I started this journey into learning the stock market and learning investment platforms and was developing our strategy, I came across the Contrarian Outlook team and I like their message. It's a no withdrawal portfolio and it's designed to reap dividends instead of slow cash outs because that 4% method is dead. Uh, 4% method is really brief rehash because, and I've said this before on videos, the 4% method is if, and that's the biggest if in font you can make, if you hit $1 million invested, 4% means the market would gain 4% a year and you would take 4% out every year. And that would be the retirement that you would either supplement or that you would live on, pending your prior arrangements or your alternative arrangements. 4% of $1 million is 40 grand. Tell me, I mean, outside of somebody who's fresh out of retirement, right? Like you worked maybe 5 to 10 years and you have $1 million invested, 40 grand is close to what you're making as a newbie professional, pending your profession. But for somebody who's been in the workspace for 20, 30 years, you're not living off of 40 grand when you retire. You're living off of 70, 75, 80, maybe 90 or 100 grand. So to go from 100 grand a year to now existing only off of 40 grand a year is ludicrous. And you're selling off your funds like you would dollar cost your way there. Now you're dollar cost, like reverse dollar cost averaging your way out of retirement. So if the market gains 4% a year, that's hit and miss. It's at least 4% of inflation. And if you're living off of 80 grand a year, so that's 8%. So you have 8%, 80, 4% with inflation, that's 12. That's 120 grand a year. Maybe you never take out 120 grand a year, but you're losing 4% out of your portfolio just from inflation every year. So there's no way to effectively stay retired off that $1 million by the old guard's strategy. It's flawed strategy. The guy who invented the 4% rule isn't following the 4% rule because for him, it was not enough money. And he invented the 4% rule. So he's bound to have more than $1 million invested. And 4% of whatever he had wasn't enough money. So for you and me, if we're hitting 4%, it's 40 grand. If you're not hitting 4%, if you're not hitting $1 million, it is not 40 grand. So what do we do? So instead of selling off our principal, it's a no withdrawal portfolio. We reap dividends and not slow cash outs. And for right now, everything gets reinvested because we're growing that principal. We target crazy discounts. Can't do that in the regular market at large. We target crazy discounts. We target 9% plus dividends generally. Today might be a little bit different, but generally we're targeting 9% dividends and not that 0.5% BS you're getting from Apple. Apple's a great company. They pay a 0.5% dividend. If inflation is 4%, you're gaining a 0.5%, and then you're losing 3.5% to inflation or the devaluation of your money. We take Warren Buffett's advice. Warren Buffett has this great kind of, I won't say off record, but to most investors, it doesn't make sense. It's buy stocks for 66 cents instead of $1. Which if it's like, can I buy Coca-Cola for 34% off? Like if $1, right? So 34 cents off $1 to get, could I really do that? In a closed-end fund market, you can. So if we look at break even on percentages if 0% is $1, then something that's selling for 20% off is now 20 cents less. So that's 80 cents instead of $1. Currently, there's a fund selling for 44% off. And let me make sure my math is right there. Yeah, almost 45% off. So to buy that one fund, which I'm going to explain here in a little bit, you're getting something for 55 cents instead of $1. That's Warren Buffett. So Warren Buffett invests in closed-end funds. He doesn't pay dividends. He reinvests everything into Berkshire Hathaway. Berkshire Hathaway gets paid dividends, but they do not pay dividends. So how do we do this? So if we look at the market at large, right, the Fed has stalled rates. You've got a lot of people kind of waiting in the ranks. You've still got that sect of people tied down to that 60-40 overall structure. And they are like waiting on the ramp, jumping up and down, waiting for the Fed to cut rates. And in that, as we look at the market at large, you've got Bloomberg, who's late to the party pushing bonds. The Contrarian Outlook team, the people I trust the most, are split in their advisement. You've got some saying, hey, we should just kind of hang out and see how it goes. You've got others going, hey, it's a great time to buy. And I'm kind of in the midst of that. You have investment companies still looking at closed-end funds like a regular stock, and it's a completely different breed of animal. The most telling market at large sign that I've seen is Facebook Marketplace. I look at Facebook Marketplace almost every day. And I used to look at just furniture and I would see some classic cars, some maybe you wouldn't call them classics, but just some older cars on there. Lately, that thing is overflowing with toys, like pretty decent condition 1940s, 1950s, 1960s classic cars, but also the rarer cars like the Studebakers and the old Pontiacs, like the really cool rat rod base form Pontiacs. And they're all in decent condition. So I think people are feeling the economy a lot more significantly than what these talk show guys are telling us. And as much as you want to rebrand and reterm what a recession is, people are still feeling the effects of that. And they're at a point where they're either willing in cutting costs or they have to cut costs and they're selling their toys in front of this worsening economy. So the bigger, well, I'll say, I think Facebook Marketplace is probably the biggest indication. Bloomberg being late to the bond market is second. The other stuff is periphery, but at its heart, I think you still have to take into account CNN's fear and greed index, which I don't like anything on CNN outside of this index, but it's a really good pulse on the market overall. Last week, we were in extreme greed. And if you're looking at this pendulum of things, so in the extreme greed category, you have all these newbie investors late to the party. You have Bloomberg late to the bond party. You have all this kind of, all money's green, but you have this green, like new money pouring into the market because they see that the tide is changing. And when that happens and it spikes the fear and greed, or really not fear, but it spikes the greed and then extreme greed, you have more money in, sensing a change in the market. Something will disrupt the market and it'll go from extreme greed last week. This week it ended on fear, or it ended on a greed. There's a neutral area, and then fear and extreme fear. So if you're buying in greed and extreme greed territory, you have to make darn sure you're gonna get a good discount. And if you are going to invest and pursue the good discount, there's no better place than the closed-end fund market. The flip of that is if you're buying in extreme greed, you're generally going to pay more for something than you would otherwise. So when you have all this new money or all this green, crisp money coming in the market with all these new investors, guess who's going to pull out when things get fearful? All that new green money, because they don't want to lose the value of their money. They're not in it for the long haul. They see the easy score. They're not worried about all the turbulence. So when that meter flips back to, so we're extreme greed, now it's a greed as it flips back to neutral fear, maybe even extreme fear, that's the best time to buy because you get things cheap. But it's not put in that light on all these talk shows. It's people are hesitant to get in the market. They're scared. They're worried about this. There's interest rates and this and that and the other. But that's the best time to get in. And I forget which Rothschild said it. Uh, like the best time to get into the market, best time to invest is when there's blood in the street. And sometimes that's when your own blood is in the street. Uh, the fund that's pretty much top of the list tonight is we own the fund and the dividend's been hit and the price has been hit and it's currently selling for an amazing discount and it doesn't tick our 9% parameter, but it's still a really good fund. And we got dinged up because they cut their dividend and the company got dinged up because they cut their dividend, but they're also uh, updating their portfolio and they had to cut the dividend. So long term, like if we look at right now, yeah, they cut their dividend, the price dropped. If we look long term, the dividend will grow and the price drop means you can snag a really great deal at a really cheap price. So, but I get to that in a minute. So if I look at the market at large and then I factor that into my strategy, what do I think? Where would I invest? So it comes down to knowing your strategy. Are you going to buy low and sell high? Are you going to dollar cost average your funds? Are you investing for the short term? Are you looking for the quick score? Are you building something? Are you building something that will help you in your retirement and that you can hand off to somebody else? Like if I built my R portfolio to have it pay dividends long term, that I can then pass it off to my child, whether she's into this or not, it'll still just go. If for us, we're looking for that no withdrawal dividend portfolio until we need to take out those dividends to supplement a retirement, right? We want to use the fear and greed index, but also not get trapped inside the fear and greed index. So here's my cork board, I guess you could say, of targets. I would look at bonds if you can get those at a discount. If you're paying market price or above market price, that's not helpful. I still think you look at energy infrastructure. So you look at oil, liquid natural gas, energy transfer, utilities. Oil is such that we have all this other stuff and it's integrated into society more than people think. So let's see how to say this. So there's a commercial on for the local power company, like one of the bigger power suppliers, that said you could get free solar during the day and you could sign up for free wind at night. Both of those are contingent upon the production of those uh, resources. So, and they don't tell you the parameters of, so like if you're not getting free solar, you're paying for full power. So what's that actually going to cost you? So solar panels are made from oil byproduct. Wind turbines don't turn without diesel and oil. If you're plugging your car into an electric vehicle charger at your house, that's coming from a power company who needs oil in order to run a company. And if that's powered by coal, there's oil in the harvesting of the oil of the coal. If it's nuclear power, there's oil as all those machines run. If uh, let's see, if you're scared of the oil and gas on the front end for your car because you're worried about carbon, the power plant that's powering your car is doing the same thing. And all the renewable resources of using your car, all of those are extracted from the earth. They're not refilling and replenishing. You're kind of scarring the earth worse than it was already scarred. Uh, Oil and its byproducts are used for all these other renewable resources. And those renewable resources, solar, wind, um, I'm sure I'm forgetting something else, water, all of those other things would not compete in the oil market unless the government subsidized them or offset them. Yeah, cat's running from his medication bowl. Um, from oil, we get paint thinner and paint sealer and wood stain and wood sealer and the parts for a fridge, this laptop, this mouse. There's so much that comes from oil, pacemakers, MRI equipment, right? Part of the rubber for tennis shoes. All of that is oil byproduct. So the country needs oil and its derivations in order for all these other electrical services and grids and it to function along with all the energy transfer. But technology needs oil because technology is based upon oil. It's not just that it's based upon the value of oil. It's because the parts are made from oil derivative and producing that needs oil and shipping that needs oil. Everything is oil based, whether you like it or not. So corkboard. So bonds on discount, of course, energy infrastructure, data management, cloud tech. That's not necessarily the production of those technology pieces. It's the management of all that data. Uh, and then last is either real estate or real estate investment trust. And then with that, you get convertibles as well. So something that will blend well or is easily switchable between bonds and stocks. So enough of my general commentary. Let's look at the actual data and see where the best discounts are for the week. So this is the closed-end fund master, meaning it's got all 400. It online says 422, and on this page it is 423. And I went back through individual ticker by ticker to find out where the disconnect is, and I did not see an issue anywhere on that list. So it's either 422 or 423 current closed-end funds. Average yield across all is 8.5%. Uh, Generally, the complete list and all the data sets get updated monthly. The color coded, so the purple, the blue, and the green get updated weekly. So if we look at everything, it looks very jumbled. Like the gray coloring is because the dividends are either less than 6% or the individual share cost greater than $16, or in a couple cases, uh, let's see, we've owned a company and just don't like how the company's run, like this. So it's under, excuse me, under $16 easy. The dividend for sure is greater than 6%, but we've owned this company and I'm not a fan of how they're structured at all. Uh, yeah, so gray is what's been filtered out. So how to sort the list? We rank by dividend, or sorry, we rank by discount. And I'll scroll over. So 3 asterisks is a buy alert, meaning the current discount is greater than the fund's historical discount, really double than the fund's historical discount, and it's greater than the 5-year discount for each fund. Uh, 2 would be a dollar cost average based on what we already own. So we own everything in blue. And then 1 is just tracking for any number of reasons. So we scale by discount, and then we organize by asterisk. And then I take this, but I'm also going to come back to this list. Current would represent how many shares we currently own. So now we sort. So all of these have significant discounts, and it's individual to the single funds relating performance, not the market at large. So we can rule out how amazing the discount is. So generally, next I would rule it, and they all meet our buy parameters. Well, not the recommended ones. And the recommended ones are on the list, but at the same time, they're going to get sorted out. We sort by yield, and then I would take out everything under 9%. The caveat to that is some of these are municipals, and the tax equivalent yield is greater than 9%. And this HFRO is going to stay on the list because its discount is so severe. The greater than a 9% dividend. Greater than a 9% dividend. That should be it. I think there's only 2. Nope, I was wrong. There's 3. So from there to there is not 9%. Those don't look like 9%, but their tax equivalent yield is 9%. And that's coughing noise you hear in the background is a cat barfing. Amazing. Wonderful. Wonderful. Probably because he ate dinner way too fast. And this one is, yes, under 9%, but it's got an insane discount. Um, so then our targets have been monthly payers. So we can take out what's not monthly. Um, and then it comes down to those overall standards. So you have bonds, energy infrastructure, real estate or real estate investment trust, data management. And because I'm not afraid of showing off my cork board of things. So yeah, bonds, energy, data, and then real estate. Um, so we're already invested in everything blue. Me personally, I like buying things in sets of 50. Um, so to put a starter stake in something that we don't already own, it would have to be amazing. And anything we don't already own would have to be better than what we already have in order for me to, I mean, honestly, buy something we don't already have. So we don't own a municipal, but I also know I can't buy 50 of it right now because that's what I do have for sure. Could I add more? Yeah, but that's what I've got. Um, these are tempting just because it's a different portfolio structure than what we already have. They're portfolios in a can. Um, but the other caveat to this market is, and what I'll reference from the Contrarian Outlook. So you have two different analysts inside their group. One saying, if I'm buying single stocks, I'm going to sit and watch the market and see what happens because there's too much uh, there's too much swings in just the single stock entity side of the market. And then you have the guy who generally analyzes closed-end funds saying, I get what he's saying, but there's a lot of great discounts right now. And you can get a really great discount if you know what you're looking for. Me personally, I don't like the consumer end of the market because of how volatile it is. And when you factor in a lot of the funds are global, you not only deal with the US volatile consumer market, you deal with the world's volatile consumer market. It makes it seem like it swings harder, like the prices really do swing from one extreme to the next. So they can all go in your favor or they can all work against you all at the same time. Now, a lot of people put real estate in the cyclical market. And I get that, but real estate really is its own thing. Oil, you could say, is cyclical, but we've moved beyond oil being just about cars. It's about the manufacture of goods, the manufacture of all this other stuff, about technology. You want the technology market to continue to take off and do well, you have to have oil to make that happen. So, real estate, oil, to me, don't belong in consumer. What consumer would be like grills. Grills become popular in April. In April, as people look towards Memorial Day in the summer and cooking outside. But post summer, when most people have kids back in school, grills are still needed, but they're not as needed as they were in the summer. Cars are cyclical, especially the type of car. Um, Home furniture, clothing to a degree is cyclical, especially the style of clothing. Purses, shoes, belts. Belts always needed, right? They sell all year, but over the summer, heading into a new school year or winter break or a job change, right? It's more cyclical. And in making that, it's leather, but it's also sealed. So you need the manufacturer on the cow end, you need the processing plant, which needs oil in order to run. You need the oil for the sealer for the material. So you still end up with oil being always needed. So I like the Calamos funds. They've been on my hit list for a while. I mean, I like how they're structured, but at the same time, I think the other four on the list are better structured for where we are right now and where we're headed. So we end up with these four, and we own all four. I'm not really interested in buying something we don't already have unless it's just amazing. So, of the four, How do I further break it down? You have financial services and some utilities. You've got like 80% financial and it's pretty much the same fund. And in hindsight, I'll be honest. I mean, it's pretty much the same fund. You could argue that we don't need one of them because they're sister companies. That's pretty much the same exact portfolio. Um, so you could argue we don't need one of them. But for the most part, they're both structured to where about 80% is inside the financial services, which is more like consumer and cyclical, and then 20% is utilities. HGLB it's not an exact portfolio when it can, but it's a good mix. Real estate, energy, utilities, bonds. And HFRO has had the biggest shift. It used to be bonds and senior loans, and they shifted the portfolio. And I'm a shareholder and I read the company missives, but I did not catch the transition of the overall portfolio. And I can only hope, if I think big picture and where I think rates are going and the overall trajectory of the market, with the Fed pausing rates and hinting that they might lower rates this year, transitioning from bonds, right? The bond market is taken off, right? But if you sell bonds late and then get into real estate, the real estate market will have taken off with these rate cuts and then scaled higher, and you're paying more, right? So you take your profits from the bond market, which is already doing great, but you take your profits early from the bond market and you put your portfolio into real estate before the real estate market flips, just catches fire, right? And I can I can understand the bigger picture portfolio change. In doing that, I mean, I get it. They restructure the portfolio. They can't keep paying the same dividend. So they cut their dividend in half. And as soon as they announce the dividend half, the stock price falls out. I would go back to a cat sneezing and coughing. Uh, so they cut their dividend in half. And the green investor sees that. It's, oh my gosh, like I bought it for a decent dividend. It was 0.077. They cut it pretty much exactly in half. Here, I'll even type it in here. Right. So they cut it in half. And the green investor went, oh my gosh, they cut their dividend in half and they pulled their money out of the market. And I get that. Like it's not what you want to see. So closed-end funds are a closed system. There are only X number of shares. You cannot magically add shares like any other single stock. So it's really the supply and demand and its impact on pricing. You have the overall net asset of the fund, and then you can also buy it at a really incredible discount and buy it for that. And as the discount window closes, the price goes up. When people buy more shares, they make the shares more desirable and it raises the price. My cat is destructive when he wants attention. And in doing that, you restructure the portfolio, it gains more, it gains more, like it gains more value, price goes up, the discount window closes, and then you slowly raise the dividend back to where it was. That's the overall game plan. Will it happen? I don't know. It's what I would like to happen because I liked my higher dividend. I mean, you double that dividend, so it's a 13% dividend, and they paid it consistently. So you end up with banking, a decent mix, and then real estate and senior loans. And if it's us, quite honestly, we're not buying right now because of, and maybe I'm wrong, but I see people selling more of their things, the things that they really love. Not a $4,000 to $5,000 car doesn't seem like a lot, but it is a lot to some people. And they're selling their toys, knowing that they're either A, cutting costs, or B, they need to roll that money into something else. So With Facebook being flooded of cars, I think people feel the economy more than the news would like you to believe. And whether we actually have a full-on labeled recession or not, we are going to see some of that. So knowing that and seeing where we are on that fear and greed index, that we last week were in extreme greed, this week we're at greed. It's tempting to buy something, but we're not, because I want to wait for that overall sentiment to grow fearful again and buy stuff when it's lower. The only thing that's tempting is this fund. Like if you told me you have to buy something this week, I would buy the discount because, I mean, yes, the portfolio is restructured. They cut the dividend, right? The price went down. It's incredibly cheap. But if we go back and look overall at the, so we're focusing on monthly income. And yes, generally 9% or greater dividends. So you have annual category 3. This was relabeled. It used to be DNIF. The discount never really changed. Now somebody else has the same portfolio with a different name, but that's annual. Their sister fund is also monthly. They cut their dividend a little bit, not as extensive, same thing. They cut their dividend. It used to be 0.084. They cut it down to 0.081. It saw a little pricing, like it dropped in price, and now it's rebounding. It does pay well. And they've already narrowed their window. I mean, 3-4 weeks ago, it was at a 30% discount. So they've closed that window overall a little bit. But then you look at the other options at the top, especially what we already own. But you look at the other options at the top, you've got annual, this is monthly. It sounds great, but it's aligned with groups that are outside the US, and that's not my cup of tea. And then you look at under what's after that, like you don't find the next monthly thing for a while. Yeah, for a while. And it's not a buy signal. So if you forced me, if you said you absolutely have to pick something to buy this week, I would buy the discount. And you could argue that that'll give you a better dividend in the short run and maybe even in the long run because it pays a better dividend than that did when it was at a full dividend, maybe. It's definitely structured well. Real estate, energy infrastructure, utilities, bonds, right? That one's prepped for what we all hope will be the coming market, but we haven't seen that market yet. So of what we have, it's a pretty even split all the way down, right? But it goes back to the overall deal. That is an insane deal. And that is an insane discount that you really don't find that often. They've flirted with this number before, but you really don't see that steep of a discount that often. And if you said you had to buy something, I would just pick up 50 shares of this because overall it would drop. And yes, this is our actual portfolio. Overall, it would drop our overall average. It's a great dollar cost buy. It's an insane discount, and the dividend will come back. Close second would be this one. And I get that they're all, like twice as much as those, but the close second is this one just because of how it's structured. Still an insane discount, but the discount itself has gradually declined the last 3 to 4 weeks. So I would buy the discount, even though it doesn't hit 9%. I would buy the discount if I had to buy anything. But me personally, I'm going to wait at least, well, we're going to wait. I'll put it that way, whether that's a week or more, and kind of see how the market feels out, see what things are. I mean, the market, it changes every week. See what the market brings, see how things go, see if that overall fear and greed index shifts a little bit, see if it drops to neutral, if it drops into fear. That's good territory. If it drops into extreme fear, as fearful as that talk show circuit guy or talk show circuit network of guys, gals, whoever wants to push fear and it's a great time to pull out of the market, that's really when you'll find an amazing deal that's cheap. Like maybe you'll get the same discount and that'll be about $1 lower. And I'm not saying that it's going to happen for this fund. That's not my point. But when you extreme fear means the discount widens. So you get this insane discount with like $1 lower. And that's a little higher because that number is reflective of that dividend divided by that cost, right? So everything stays the same. If that goes to $6, oh goodness, wrong number to change. If it goes to $6, you get a slightly better dividend. Live video, it is what it is. Or at least unfiltered, unedited video, it is what it is. You get a slightly lower number, so it makes your yield go up a little bit, but we're looking at the overall long-term dividend plan as you own the fund. So insane discount now, decent pricing now, lower than what we already paid for it, dollar cost average deal. It would be what if you were like, yeah, you have to buy something, I would buy this. We would add money and we would buy this. But for us, for right now, we're going to hold this week and not buy anything. So, uh, yeah, honest content. Maybe you get that somewhere else, maybe not, but honest content. So if you like this, if you like the advice, if you like the explanation, if you like the strategy, consider subscribing to my channel. Hit the like button, then head over to Facebook and check out the main page, the Navigate Your Finances page, and see what you feel, see what you like about the overall strategy there. If you need help in your college endeavors, check out my scholarship page. The information will be below, or the information for the Navigate Your Finances will be below. Uh, as you go forth, you are the captain of your ship. It are the best way to phrase this analogy randomly on a show tonight, probably from a show 20 years ago. If you have no idea where you're going, it's really hard to get there. But the further expanded version of that is if you have no idea where you're going, it's really hard to not go. It's really hard to go anywhere other than where the wind sends you. It's kind of like you're floating in open water and the wind is controlling your course and not you. So if you have no idea where you're going, head over to Facebook and let's talk. Like, look at the files, look at my content. Let's see if we can help you figure out what it is that you want to do and develop a plan to actually make that happen. So you're the captain of your ship. No one else will pilot your boat for you. You have to figure out what you want to do. And then I can help figure out how to help you do what you want to do. Your dreams are your dreams. My dreams are mine. It makes very little sense for me to help you accomplish my dreams. I want to help you accomplish your dreams. So pilot your ship wherever it is that you want to go. And if you have no idea how to do that, then please, please go to Facebook and let's talk and let's figure out how to make that happen. Whatever it is you want to do, whatever it is, live on a houseboat, backpack across the Appalachian Trail, uh, hang out in a car, travel the world, like whatever it is, that's not just going to manifest and poof into existence on its own. Like there's no amount of positive thinking that will make all of that happen where you keep all of your existing habits, right? Like you want that outcome. So the existing structure stays the same, right? Your job, whatever you got there stays the same. So if you want a completely different outcome, if you want this other pathway open for you, you're going to have to change your response to that because whatever you're doing now isn't going to make that happen. So if you want that other outcome, if you want that other ending, if you want to actually accomplish your dreams and change your dreams from dreams into reality, then head over to Facebook and let me help you. Check out the content, see what you think, and roll with it. Or if you need help, ask me a question. So, whatever you have for the week, I wish you well. Whatever your strategy is, I hope it's going well for you. And if you're uncertain, there's no better time than to rethink and re strategize and employ something different. So, hope you have a great week. Talk to you later. Bye bye.